Very special guest to talk about the global trends and how are global markets looking from here on until the end of the year or maybe longer. Peter Oppenheimer, he's Chief Global Equity Strategist and Partner at Goldman Sachs International, joins us on the show. Peter, good having you. Thank you so much for taking the time out. The last few days sitting out here in India, we've been besieged with news flow in the emerging markets in a meaningful way, be it Turkey, be it Argentina, be it the recent news flow around Brazil and the political situation there as well. Add to that, the whole trade spat between US and China is dominating headlines. How are you reading all that's happening in the world markets and the impact that it could have on equity markets from now on until the end of the year?
Well, thank you for having me. I think that you're right in terms of the focus of investors at the moment. It is very much on two issues, and they're related. One of them is trade and where the potential trade tariffs end up in the case of the US and what the repercussions for that may be globally on the economy. And secondly, on emerging markets. And as I said, in a sense, the two are linked. Our view is that we will see more tariffs from the US, particularly related to China, as they have threatened. But we do not think this will escalate into a broader and deeper global trade war. And when we look at the impact on global growth of the kind of scale of tariffs which the US administration have talked about implementing, we think the overall effects are relatively small, knocking 1 or 2 tenths off growth, for example, in the US and China. That said, I think that this issue is going to continue to be a focus through to the end of the year, and it raises uncertainty because it, of course, the reaction to the implementation of tariffs could be that you end up with a greater escalation of a trade war, which has a bigger impact on growth. In terms of emerging markets broadly, we see many investors as being rather concerned about the risks of contagion from the countries that you've already mentioned. On this particular issue, we're relatively more sanguine. We think that overall emerging markets in equities are offering good value, and most emerging markets are not as vulnerable as they were, for example, back in 2015 or 16 when the dollar was rising and US interest rates were picking up, because most countries have less imbalances now than they did then.
Interesting. Are you more sanguine about the global GDP growth numbers from now on until the next 18 months? Or do you believe that, specific instances like crude notwithstanding, there could be some headwinds coming into growth because of technical factors in the US and the European region, the QE tapering or pullback, or higher interest rates, which the Fed has almost made it a given that will happen. And back home in India as well, we're seeing signs of that. Could there be impediments to growth over the next 18 months?
Well, we certainly think that global growth will slow over the next 18 months. We've just seen incredibly strong growth numbers, particularly in the US. The second quarter was revised up to more than 4% at an annualized rate. We think that will be the cycle peak. And we've also seen other parts of the world, both Europe and Asia and emerging economies, slow from the very fast rates of growth that they saw at the end of last year and the beginning of this year. But we do expect global economic growth to remain at close to around 3% over the course of next year, slowing a bit beyond that, but still positive. So although this has been a relatively weak economic cycle globally, going back to the financial crisis a decade ago, it's likely to end up being the longest global economic cycle. And we think that will continue to support global profits. Although they'll be slowing relative to the pace we've seen this year, they're still likely to be positive, and that should support equity markets too.
The camp is divided between the impact that the gradual QE tapering will have on the markets versus people believing that while it is gradual in nature, it is right there and evident and a stark departure from the easy money that we've enjoyed for the last 8.5 odd years. What are your views here?
Well, you're absolutely right. It's a very different environment that we're moving into. The crisis economically and in financial markets a decade ago was very extreme, but the policy response to it was unprecedented, with global rates moving towards zero and the adoption of quantitative easing in one country after another. We are finally coming out of that phase of extraordinary policy easing, and we are likely to see rising rates, particularly in the US. Our own view is that rates will rise in the US next year more than the markets are currently pricing, and we expect the exit of QE also from Europe as well. I think the most important factor that this is likely to result in is no further valuation expansion in financial assets. If you look at bonds and credit markets, equities too, they all enjoyed significant rises in valuation as a result of interest rates falling to record low levels and the impact of huge amounts of global liquidity. That process is now coming to an end, and we think that as interest rates in the US rise and as you start to get an exit from QE, you're likely to see valuations remain contained or even moderate a bit. And therefore, in the case of equities, it will really be profit growth alone that drives the return. And we certainly expect to see lower returns in equity markets and indeed in bond markets over the next couple of years than we've seen over the last few years. But still, in the case of equities, positive returns.
How do markets behave then, Peter, over the course of the next few months? Simply because as in the US, so in India, we're seeing a very narrow set of stocks taking these markets higher. In India, there's stark evidence of that. In the US, the famed FANG rally is leading these stocks higher. I'm sure it's not just the FANG stocks, but a few others too. But it is largely a narrow market. Is that a cause for worry, or are people making too much noise around this issue? How does it matter if it's a select set of stocks which are doing up right now and maybe a new set of winners will emerge in the next year?
Well, I think that this narrowness and sector dominance that we've seen, particularly in relation to technology, probably will continue. The reality is that global growth is, we think, going to be positive but relatively slow. But more importantly, companies globally are finding it harder to generate fast top-line growth. There's just fewer genuine growth companies, and that suggests that investors will continue to seek out and be prepared to pay a premium for genuine growth companies. Many, not all, are in the technology sector, and the technology sector has really dominated this global bull market in the last several years. But it's been driven not really by valuation expansion, but by genuine profit growth as these companies really benefit from massive disruption across lots of industries. It's not untypical for market leadership to narrow in the later stages of bull markets, but I don't really think this is likely to change very dramatically. And I think that investors will still seek out and pay for companies that can maintain, grow margins or top-line growth. And there are a narrowing group of those companies available to investors globally.
Well, in India as well. My last question, Peter, and specific interest to people out here as well. I don't know how closely you track India, but a top-down call maybe, or a view on India as a market. It's done really well compared to the rest of the EM pack, particularly in the last 3 or 4 months of the current calendar. But an expensive market showing visible signs of growth, both on the GDP and on the earnings. Any thoughts here?
Well, I think that India is an economy with tremendous growth potential, and although is seen as an emerging economy, it doesn't suffer from the big imbalances that you see in some of the countries where the current focus is most intense. And plus, you have some very exciting growth companies. which, along the lines that we've just been discussing, are attracting both domestic and international investors who are looking for genuine growth opportunities in large markets which are expanding. So I think the prospects remain very positive, particularly in the long run. And although there's a lot of intense focus right now on emerging markets and the fear of contagion, we think that those fears may well be overdone, and that although there are specific concerns in some emerging economies which are facing particular economic stress, that's not true for emerging markets as an asset as a whole. And I think that investors will continue to be more differentiating in the space.